Now, once we've learned how to do that, once we've learned to put in this advanced order which says we want to sell at this price, we can then learn to lock in our profit. How would we lock in our profit? We've set up a stop order initially just in case the market crashes against us, but once we've made 15% or we've made 20% or we've made 25%, we're going to review our investment every now and again. And when we review our investment every now and again, we're going to go, oh, our investment's gone up 5% now, so we'll move our stop order up 5%. Our investment's made another 10%, we'll move our stop order up 10% now. And eventually you get to the point where the point at which you're saying you want to get out of the market, if it falls back, that is over and above now the price where you originally got into the market. So you've locked true profit in. Now remember that a fund manager can't do this. A fund manager has to let the market just crash, because if they sold, they would crash it even further. So a fund manager, in effect, so you get your review from your financial advisor and you say, oh look, since I started investing, my investment's gone up 30%. And that's taken 5 years. That could be wiped out in a market crash. Everything you made in those 5 years could be wiped out in a market crash. Whereas if you're a private investor, you can say have your stop at 15%, which means you would only lose 15% of what you'd made so far, and you wouldn't lose the rest. Now there is a reason why I'm saying put your stop 15% behind where you originally went in, and we're going to get to that later on in the program. Because you might be thinking, why can I not put it 5% behind where the price actually is now? And there is a really good reason for that, which I'll tell you later. And basically you need to let the market fluctuate in order to do this in a sensible and profitable way. But the main point is here that you can lock in profit as you make it. So you would keep reviewing the price as it moves up of your investment, and you would raise your stop order level to lock in profit. And you would keep doing that as your fund or your investment kept going up in value. You would keep banking profit and keep moving up your stop loss. So to give you an example, let's imagine after this market crash which I showed you earlier, we got in 2009 as the market started recovering, and we kept our stop 15% behind the current price. So you can see on the chart here that, can you see the price moves up and then it falls back and then it goes up again and then it falls back and it goes up and falls back and it goes up and falls back. This is a very common pattern in the market. There's always fluctuation in prices, but you can see here quite clearly that the general direction is up. Now let's say we just keep moving our stop up as that happens over these years, 2010, 2011, 2012, 2013. We keep moving our stop up, staying 15% behind the current price. If we did that, we would stay invested in the market until this point here where these new lines are. And this is the height that the market got to in 2015, and then it fell back, and it fell back from that high to that low, and that pullback was 2,981 points, which was actually 16.2%. So if we'd had a stop set at 15%, that movement there, when it fell back, would have executed our order and we would have sold out of our investment. So we would have stayed in for all those years because we stayed 15% behind, but we eventually get taken out at that point. So we invested in 2008 at 8,000, and we keep raising our stop loss, keeping 15% behind the current price, and we get stopped out in 2015 at 15,500. So you might think, oh, I lost all that money when the market pulled back from its height. You could argue that yes, you did, but remember, you don't make money until you actually come out of the market. Just because it says on paper you've made some money, it doesn't mean you've made it. So it's the start and the end of your trade that are the relevant things, the start and the end of your investment. So what's the profit you made between where you got in? You got in at 8,000 and you've got out at 15,500, because remember, you've got out at 15%, so 16.2% is a low of 15,370, but you actually got out a bit higher than that because you came out at 15%. So what you actually did was you came out at 15,500, yeah? And how you work out your percentage profit is you take the return you've made, which is 7,500, and you divide it by your initial investment, which is 8,000, and then you times it by 100. And what you find is, even though you've lost a bit of money in that pullback, you have actually made 93.75% in that 7-year period by keeping your stock 15% behind and just managing it up. Now, isn't that amazing? For 7 years. Now, bear in mind that we said the annual return that you get with a fund manager after costs is 3%. Do you remember that? And what I've shown you to do here isn't anything really complicated. It isn't anything fancy, and you can get some massive results with this process. So my question to you would be, can your fund manager do that? And I think they would be hard pushed to get that kind of result. And it's just a simple investment method, and that simple investment method I've just shown you there is what we're going to talk about next, which is protected investing. Now, why then, let's just cover the question about why then did we keep 15% behind. It's because, as you can see, as the market goes up, it pulls back a bit, then it goes up, then it pulls back some more, and goes up and pulls back some more. And if you have your stop too close, what you do is you keep coming out of the market, and you then find it very difficult to decide when to get back in because it keeps pulling back, and you get all confused and you end up not investing at all. Take my word for it, that's what happens. So what I'm trying to do here is give you a really simple process and approach that means you will have very little interaction with the market. You won't move in and out of the market a lot of the time. You will just stay invested in it, and you'll have a really simple way of taking advantage of the market as it recovers. It's back to the price it was before. So that's our brief look at Revelation, and hopefully you are now feeling so happy about this approach. And obviously, as we go through the program and we look at the actual strategy, we're going to go into even more detail about exactly how to do that. But I just wanted to show you how that worked and what the advantages were. So I'll see you in the next video.